Hi, my name is Nick Brightbill. I'm a financial advisor here with Hershey Financial Advisers, located in Lancaster, Pennsylvania, where we're headquartered. And I wanted to come to you today to share with you just a little bit about a retirement plan aspect called the required minimum distribution. So if you have been given the opportunity during your working lifetime to put money away into a qualified plan that either you provided as the employer or for your employer that you worked for, that's a great gift, right? It gives you the ability to put money away for the long term. So as an example, say you have $100,000 of income. That $100,000 you choose to put away 10% of your income into a qualified retirement plan. A qualified retirement plan could be anything stretching from a 401k to 403b, simple IRA, SEP IRA, 457 plan, and there are a few others. You put that money away in pre-tax. So if I put in $10,000, that gets deducted off of my taxable income. Then hopefully I've invested that money well, and that grows over time. And then once I get to 59 and a half, I have the ability to access that money now without penalty. Not without taxes, but without the additional penalty, which would be 10% if I withdrew money out prior to that. There are some other rules there that might allow you to withdraw sooner, but you'd want to consult with your financial advisor to know exactly what that is and how it works. Once you get to 59 and a half, you have this window from 59 and a half right now here in 2024 until 73. Once you reach the age of 73, you have to start taking what is called required minimum distributions. Now, the required minimum distribution is calculated by taking your IRA balance. So let's use simple numbers here. If you have $1 million in your IRA balance, you're at age 73, and you now want to take, you're now required to take out that distribution. There is a snapshot taken at the end of the prior year, and that's the number you use inside of that now tax year in order to take the amount of money that's required. That amount of money is determined by a uniform lifetime table that the IRS put together that says here is the dividing number, and then here's your balance at prior year end. You take that number divided by that, and it breaks that down. And in the first year, it comes out to roughly 3.5% of your overall balance that you have to withdraw. So if you have $1 million value inside your IRA at the end of the prior year, it could drop even going into the next year, doesn't matter. Or it could go up, doesn't matter. It's based on the prior year number. And then you have to withdraw out roughly $35,000, comes out to around 3.5%, out of that account and put that into wherever the money needs to go. It just can't be in the IRA anymore. It can go to a non-qualified or a non-retirement investment account. You can receive it and put it in your bank. You can get it and give the money away to your kids. You can do whatever you'd like with it. There are some more strategic ways if you are looking to give the money to charity out of your IRA, and I'll talk about that in another video. So you're required to take this out. When you do take it out, again, the IRS was good about I can deduct it off my income when I contribute it. I get to defer taxes on all the growth, and then when I go to take it out, they're going to take out for the amount of taxes that I would owe based on my household taxable income. So if you have, if it's you and a spouse, and even you if it's single, you have any and all of the incomes that are tied to your tax return. So if it's you personally, it's just your incomes. If you have a spouse, it's yours and your spouse's income. So it'd be Social Security, pensions, other means that you are drawing from that can count as income, and that has to all go in that calculation to determine what percentage of tax you take out of there to pay taxes federally. Now, depending on which state you're in, different states have different rules regarding the state tax distribution. For example, in Pennsylvania, there is no state tax on distributions from your IRA. And if you're in North Carolina, for example, it is a 5% state tax on IRA distributions on top of the federal income tax that you're supposed to pay on the withdrawal. So this is a fairly simple thing to handle, but it is something that has some detail in it and does require some foresight on your part and your advisor and their team and their service team to be able to help you execute this correctly. You could choose to take it month to month throughout the whole year, as long as it equals that total amount by year end, or you could choose just to take it at one time. We have clients that do both of those options. Now, if by chance you get to the end of the year and you didn't talk to your advisor, you weren't thinking about it, or you didn't get the things in the mail or the phone calls that they tried to make in order to help you do this, and you forget to pull the money out, it is a 25% penalty when you take the distribution out then the following year. I didn't say 15, that's right, 25% penalty. So this is something, if you're approaching age 73 or already there right now, that you want to pay attention to, that doesn't occur to you, right? It's, again, the platform will actually calculate it. Most of them do, like Schwab, Vanguard, Fidelity, all of those and all the other platforms usually do the calculation, so they have the number for you. You always want to do the calculation with the IRS table number, last statement of the prior year, what was the end balance on 12/31, and you can use the table to do that, to calculate it, to make sure that the number is actually correct, and then you're pulling that out in order to meet your required distribution. Thanks so much for watching this video. If you like this video, please click the like button below. If you have questions or anything else, please reach out to us. You can email us, go to our website, and we could possibly start to help you on your financial journey. Again, thanks for watching. Look forward to talking to you again soon.